So this is November 2018. Question number 6b, which will be dealing with EOQ. EOQ is economic order quantity, which is the quantity which minimizes what? This is a quantity which minimizes total cost. Quantity which minimizes total cost. Total cost of the material. That when we order at EOQ, then we shall be able to minimize. The main objective is to minimize the total cost. So our question reads, Bonax Limited uses material MN23 in the manufacture of its product. The material is purchased from Zapak supplier at 30 per unit. The following data relates to the material. Requirements per year is 480. Cost per order is 11 to 50. Annual stock holding cost is 10% of the material price. So we have our annual demand. Annual demand, which is 480,000. 480,000 units. Then the cost per order. Which is Kenya shillings 11 to 50. And then we have the other one is annual stock holding cost. Holding cost per annum, 10% of material cost or material price. And we are buying at what? 30. Material price is 30 shillings. 30 shillings. So number one, we need to calculate the EOQ. And our EOQ is normally 2DCO over H, where D is the annual demand. CO is ordering costs. Ordering cost per order. And H is our holding cost. Holding cost per unit per annum. So in our case, we shall have our annual demand is 480 and our ordering cost is 11 to 50. Our holding cost is 10% of material price. Material price is 30 by 10%, and we find the square root of that, which will give you, this will be 3. So 2 by 480 by 11 to 50, and you divide by 3, square root of it. It will give you a value of 60,000 units. So that is our minimum order. That will minimize 60,000 units. Number 2, ordering cost. Annual ordering cost. Ordering cost is normally D over Q, CO. The demand over EOQ, and you multiply by the ordering cost. This will be, our demand is 480. Our EOQ is 60. And our ordering cost is 11 to 50. It will give you shillings. 480 divided by 60, and you multiply by 11 to 50. 90,000, the ordering cost. Then Roman 3, we need annual holding cost. Annual holding cost. So holding cost is a half QH. A half QH. This will be a half. Our Q is 60. And our H was 3. 10% of 30. 90,000 again. 90,000. And Roman 4, annual total cost. So the total cost. In this case, our total cost will be purchase cost plus ordering cost plus holding cost. But if they just talk about total relevant, if it is relevant, is ordering and holding, because they normally say purchase cost is only relevant when they are discount. But in this case, they just need the total cost. So purchase cost, we are purchasing for 80 at 30. We add 90 as our ordering cost, and we add another 90 as our holding cost. It will give you a total of what? Uh-huh. 14 million? 580,000. That way. And number 2 of it, ZPAC Suppliers has offered a discount of 2% if the firm purchased in lots of 120,000. Determine the total annual cost and advise the management on whether to accept the discount or not. So here we, when we talk about EOQ with the discount now, and at the second part, EOQ with discount. And with the discount, our minimum is what? To qualify is 120,000. Huh? Yeah, 120,000 units. That is the minimum order that we must purchase in order to qualify for the discount. So when you're dealing with EOQ with the discount, we don't use the normal EOQ, but now we use the minimum quantity just to qualify for the discount as our EOQ. Therefore, our total cost, our ordering cost first, we have said is D over Q, CO. This will be for 80 over 120. Over 120 by 11 to 50. It will give you 45,000. 45,000. And holding cost. Holding cost. It will be a half QH. And this will be a half by 120. Our H will be 30 by 98%. So you're given a discount, a discount of 2%. So our selling price or our purchase price will be now 98% of 30, which will give you Kenya shillings 1,764,000. A half of that by 10%. Sorry. The holding is 10%. So first we get 98% to get the selling price. Then 10% will be our holding cost, which will give you now get what? 176 200. 400. 176 400. That way. So that our total cost, which will be the purchase cost, 98% you've gotten what? 480 by 30 by 98. 98% of 30. It gives you a value of, yeah, by 480. It will be 14. 112,000. Do you get that? 14 on 12. Then you have the ordering costs. Already you have calculated 45,000 and the holding cost of 176 400. So your total, okay, just a minute. 14 400. Yeah, that will be our total cost, 40,333,400. Remember, without the discount we had what? 14,580. So the question was, advise the management on whether to accept the discount offer. Our advice, they should accept the discount offer, accept the discount offer, because it reduces the total cost by the difference 14,580 minus 14,333, 400. We'll find a reduction of 246. You get 246,600? Yeah, 246,600. That will be our reduction or our savings. As a result of accepting the discount, so we shall be able to save an amount equivalent to 246,600. So therefore they should accept. Even though when we accept the discount offer, we are increasing the minimum quantity that we are purchasing to 120, but it will save us an amount of 246. Therefore, discount is acceptable. But if it increases the cost, then it's not advisable to increase the quantity that you are purchasing. It's better just to purchase the EOQ. But in this case, because it is reducing and it is bringing a cost saving, then it is advisable to reduce that, to increase the quantity and reduce